Alphabet stock fell nearly 7% in a single day this week, wiping out over $100 billion in market value. That's one of the steepest single-day drops the company has seen in recent memory, and this time, the trigger wasn't earnings or regulation. It was a threat to Google's crown jewel, search. During a federal antitrust trial, Apple executive Eddie Q revealed that for the first time ever, the number of Google searches conducted via Safari, Apple's default browser, had declined. And it didn't decline because users were switching to Bing or DuckDuckGo. It declined because people are using AI tools instead. At the same time, reports emerged that Apple is actively exploring partnerships with AI-based search alternatives, potentially integrating a new, intelligent search experience directly into Safari. This move would be aimed at bypassing traditional search engines altogether, and yes, that means Google. If you're wondering why Alphabet's share price took such a dramatic hit, this is it. Because while Google has faced competition before, this is different. This isn't a competitor offering a better version of the same thing. This is a shift in how people search altogether. Let's start with the immediate risk, Apple. Apple and Google currently have one of the most valuable partnerships in the tech industry. Google reportedly pays Apple $20 billion a year to remain the default search engine on iPhones and iPads via Safari. This relationship ensures that hundreds of millions of users, many of whom never change their default settings, are funneled into Google's search ecosystem. If Apple starts integrating AI-based search tools into Safari, or worse, begins promoting its own in-house solution, it could threaten that agreement and eventually cut off billions in revenue for Alphabet. Not directly overnight, but over time. Quietly. Gradually. Permanently. Now zoom out for a second. This isn't just about Apple. This is about the evolution of search itself. For over 2 decades, the standard model of search has remained relatively unchanged. You type a query into a search engine, hit enter, and you scroll through a list of ranked blue links. That experience has been so dominant, so ingrained in our behavior, that Google literally became a verb. But that model is starting to break down. Today, more users are skipping traditional search and heading directly to AI tools like ChatGPT, Perplexity, Claude, or Gemini, conversational platforms that offer direct, synthesized answers instead of web pages. It's a different mindset. You're not searching, you're asking. You're not navigating, you're conversing. You're not seeing ads, you're getting answers. And if this behavioral shift continues to gain traction, the entire advertising framework that underpins Google's business is at risk. Make no mistake, Alphabet is, first and foremost, an advertising company. Roughly 80% of its revenue comes from ads, and the lion's share of that comes from search. If the search layer starts shrinking, or if fewer users interact with ads because AI assistants skip that layer entirely, Google's cash machine begins to slow. Even a 10 to 15% erosion in search traffic could result in billions in lost revenue annually. Now, to be fair, Google isn't blind to this. They've launched Gemini as both a standalone chatbot and as an embedded feature within their search engine. They're also experimenting with Search Generative Experience, or SGE, a new format that blends AI answers with traditional links. But here's the issue: Google is trying to evolve without undermining its own ad-based model. That creates friction. Companies like OpenAI don't have this problem. They're not trying to protect a legacy revenue stream, they're trying to disrupt it. And if Apple, with its enormous global hardware footprint, aligns with that model, Google's dominance suddenly looks less inevitable. Let's also talk about brand trust and user behavior. Apple's products are tightly integrated. Safari is the default browser. Siri, for all its flaws, is constantly present. If Apple overlays a smarter, faster, AI-enhanced search function into that ecosystem, especially one that doesn't feel like search but feels like a natural extension of your device, users will adopt it. Especially if it's simple, privacy-preserving, and ad-light. This is where Google faces another risk: inertia. For years, Google has been the default. It's been convenient. It's worked well. But if users find something easier, more conversational, and better integrated, they'll switch. And they might not even realize they've done it. Now, from an investor's perspective, here's what all this means. First, Alphabet stock still trades at a relatively modest valuation for a mega-cap tech name. Its ad business is highly profitable. YouTube is growing. Google Cloud is gaining momentum. They're far from a failing company. But their core moat, search, is being challenged in a new way. Not by a competitor offering a cheaper or faster engine, but by an entirely new interaction model. And the fact that this challenge is coming through Apple, their most strategically important distribution partner, adds even more urgency. Second, Alphabet's strategic response is going to matter more than ever. Investors need to see Google either fully commit to an AI-native experience, one that sacrifices short-term ad clicks for long-term user engagement, or risk being leapfrogged by newer players who aren't stuck trying to protect the past. And third, if Apple makes AI-native search seamless on iPhones, and if users adopt it, then Alphabet's search share is no longer as secure as the market once believed. This isn't panic time for Alphabet. But it is recalibration time, both for the company and for investors. Google has spent 20 years defining how the world accesses information. But the next 20 years might not look anything like the last. And if Apple takes that first bite out of Google's dominance, you can bet others will follow. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe. We cover the tech shifts shaping the next wave of investing, not just the hype, but the real strategic moves. Because the future of search isn't about where you click. It's about who answers.